Investing in stocks can offer opportunities for growth, but it also comes with risks. What exactly are these risks? In today's video, we'll delve into the risks of investing in stocks. Investing in stocks can bring excitement and potential growth, but it also involves emotional ups and downs. Market volatility can lead to rapid price changes, triggering feelings of both excitement and fear as your investments fluctuate. Company-specific issues like management problems or financial troubles can cause significant stock price drops, leading to frustration and disappointment. There's also the real risk of losing your investment if a company fails or market conditions worsen, which can create stress about your financial future. Understanding these emotional and financial risks is crucial. Let's get started. Market risk, also known as systematic risk, is the possibility that investors may incur losses due to factors influencing the overall performance of financial markets. Unlike specific risks related to individual companies, market risk cannot be mitigated through diversification alone. It arises from various factors such as economic downturns, political uncertainties, fluctuations in interest rates, and global events that impact market sentiment. During severe economic contractions, stock prices can plummet, affecting all investors irrespective of the specific strengths of their chosen companies. Recognizing market risk underscores the necessity for investors to stay updated on broader economic indicators and market dynamics. This awareness enables them to make informed decisions and adjust their investment strategies accordingly, aiming to navigate and manage the inherent uncertainties of the financial markets effectively. Company-specific risk, also known as unsystematic risk, refers to the potential for an investor to experience losses due to issues that affect a particular company. This can include factors such as poor management decisions, product recalls, regulatory changes, or competitive pressures. Unlike market risk, company-specific risk can be mitigated through diversification. By holding a portfolio of different stocks, the negative impact of a single company's performance on your overall portfolio can be reduced. Investors should conduct thorough research on individual companies before investing, including analyzing financial statements, management quality, and industry position, to better understand and manage company-specific risks. Liquidity risk is the risk that an investor may not be able to buy or sell a stock quickly enough to prevent or minimize a loss. Stocks with low trading volumes can be difficult to sell without significantly affecting the price, especially during times of market stress. This can result in investors being unable to exit a position at a favorable price, leading to potential losses. To manage liquidity risk, investors should consider the average daily trading volume of a stock and ensure that their investment portfolio includes stocks with sufficient liquidity. Additionally, having a diversified portfolio can help mitigate the impact of liquidity issues in any single stock. Interest rate risk is the risk that changes in interest rates could impact the value of investments. When interest rates go up, borrowing costs increase, which can slow down consumer spending and lower corporate profits. This can lead to a decrease in stock prices as companies face higher expenses and reduced demand for their products. On the other hand, when interest rates decline, borrowing becomes cheaper, potentially stimulating spending and business investments, which can drive stock prices higher. Investors should closely monitor central bank policies and economic indicators that influence interest rates. Understanding these factors helps investors adjust their investment strategies, such as diversifying their assets across different types of investments, to better navigate the impact of interest rate changes on their portfolios. Inflation risk refers to the threat of money losing its purchasing power due to rising prices over time. When inflation rates are high, the actual value of investment returns can diminish. This means that even if your stocks are gaining value, their ability to buy goods and services may decline. Stocks can offer some protection against inflation because companies can often increase prices to pass on higher costs to consumers. To manage inflation risk, investors may diversify their portfolios with assets that historically perform well during inflation, like commodities or real estate. This strategy aims to offset the effects of rising prices on their investment returns, providing a sense of stability and security amidst economic fluctuations. Currency risk, also known as exchange rate risk, arises from the fluctuations in the value of one currency relative to another. This risk is particularly relevant for investors who hold stocks in foreign companies. Changes in exchange rates can affect the returns on international investments. If an investor in the United States buys stocks in a European company, and the euro depreciates against the US dollar, the value of the investment can decrease even if the stock price in euros has increased. To manage currency risk, investors can diversify their investments across different regions and consider using hedging strategies, such as currency futures or options, to protect against adverse currency movements. Emotional risk in investing refers to how investors' feelings like fear, greed, or overconfidence can influence their decisions. When the market becomes volatile, emotions can drive impulsive actions such as panic selling during a downturn, which can lock in losses. Conversely, buying stocks at high prices during a market boom can lead to overpaying. Managing emotional risk involves establishing a disciplined investment strategy, setting long-term goals, and sticking to a well-defined plan. It's essential to avoid frequent trading based on short-term market fluctuations and instead focus on the fundamental aspects of companies and investments. This approach helps investors maintain a sense of control over their decisions, reducing the negative impact of emotions on their investment outcomes. Technology risk in investing encompasses the potential for financial losses stemming from technology failures, cybersecurity breaches, or rapid technological advancements that disrupt businesses. For companies heavily reliant on technology, these risks are particularly acute. A major data breach or the emergence of new technologies that make current products outdated can swiftly impact stock prices, causing anxiety among investors. It's crucial for investors to assess a company's technological capabilities, cybersecurity defenses, and ability to adapt to technological changes. Diversifying investments to include both tech-savvy firms and traditional businesses can mitigate the impact of technology risk, providing a sense of security amid the dynamic landscape of technology-driven markets. Investing in stocks carries inherent risks, but understanding and managing these risks can lead to better investment outcomes. By being aware of market risk, company-specific risk, liquidity risk, interest rate risk, inflation risk, currency risk, political and regulatory risk, emotional risk, and technology risk, investors can make more informed decisions. Diversification, thorough research, staying informed, and developing a disciplined investment strategy are key to mitigating these risks. While it's impossible to eliminate all risks, careful planning and awareness can help investors navigate the stock market more effectively and achieve their financial goals. Remember, successful investing is not just about seeking high returns but also about managing risks prudently. Stay informed, stay disciplined, and stay focused on your long-term goals. Thank you for watching, and we wish you the best of luck on your investment journey.